Hello and welcome to our discussions on accounting, and the focus of this session is on understanding the impact of buyback of shares on other accounting indicators. We know that buyback of share is allowed under the Companies Act, by which a company can reduce the capital after following or fulfilling certain conditions as given in the Companies Act and SEBI's regulations. So in this session we will take an example and understand the impact of buyback. So balance sheet is given, an income statement is given, and it says that 20% of the shares are bought back at the market price of 30, and we would like to examine the impact of this buyback on earning per share, on book value per share, and the debt equity ratio. In order to do that, let us take the workings first. So the number of shares to be bought back, okay, number of shares to be bought back is 20%. So the number of shares now at present, number of shares is equal to 180,000 divided by 10, and so the number of shares are 18,000. So the bought back shares is 20% of that, so 0.20. 3,600 shares will be bought back. The price at which these are bought back is 30, and this price means which includes the face value of 10. So there is a premium on buyback. The premium on buyback is the balance, that is 20. So that means 3,600 shares are bought back at 30, and 30 includes 10 the face value, 20 is the premium on buyback. So cash payable on buyback is equal to, cash payable on buyback is 3,600 into 30, and this cash payable includes payments towards capital, where the capital is always valued at the face value. So the capital will be 3,600 into 10, and the premium on redemption, the premium on buyback, is the balance amount, that is 20 into 3,600. So first let us examine the effect of this on the new balance sheet. We call this balance sheet after the buyback. So the capital will reduce to the extent of the face value of the shares bought back. The reserves will reduce to the extent of the premium paid on the buyback, and the cash will reduce. In this case, let us assume that the cash we don't have the cash, but let us assume that we sold shares for at no profit or loss for 150,000, because we need cash of 108,000. Suppose we got an additional cash required, so cash will be 27,000 plus 150,000, and shares will go down to the extent of 150,000. So first we arrange the cash. By plus 150,000, and investments are sold off to the extent of 150. So in order to arrange the cash, we sold the shares at the cost, so no profit, no loss on the sale, and we use this cash to make the payment. So therefore the cash will reduce to the extent of 108,000. So the cash is changing in this example because of the purchase, because of the payment and the sale of shares for the investment. So no other change in the balance sheet. The loans will remain same, creditors will remain same. However, there is a need to create CRR, capital redemption reserve, to the extent of the face value of the shares. Where will we create this capital redemption reserve? The capital redemption reserve is created by transferring from the reserves. So reserves are once again reduced to the extent of 36,000, and a new account called capital redemption reserve is created to the extent of the face value of the shares bought back. So our balance sheet will be now, the balance sheet will be the summation of all the sources, no change in the inventory, no change in the plant, no change in the accumulated depreciation, because accumulated depreciation, because we have assumed that no other adjustments happening. So the balance sheet is 972,000. So let us see what happened to the items which are affected by the buyback. Capital reduced to the extent of the face value, reserves reduced to the extent of the premium and CRR, because the CRR is transferred, reserves are transferred to the CRR. Cash has reduced to the extent of the buyback, and cash has also increased to the extent of the shares sold, because there was no cash in the beginning, so cash was arranged. So with this understanding, let us see the effect on the number of shares. The number of shares have come down. The earning per share is a PAT divided by number of shares. Before the buyback was 5.36 is the earning per share, and after buyback the earning per share will increase. So one of the objectives of the buyback is actually to increase the earning per share. The book value per share is equal to equity divided by number of shares, So let us first find the equity before and after. Equity is equal to capital plus reserves plus the capital redemption reserve. So 522. So the book value per share is equal to equity by number of share, which was 35 before the buyback and 36 after the buyback. So the buyback of shares has an impact on the earning per share and on the book value per share. Now we'll also see the impact on the debt equity ratio. The debt in this case is the long-term loans divided by equity. We already calculated equity, so the debt equity ratio was 0.57 before the buyback, and after buyback the debt equity ratio has slightly gone up because the equity has come down because of the buyback of shares. So to summarize, buyback of share is one of the ways of capital reduction. However, this form of capital reduction is highly regulated or controlled, and with the conditions, if the conditions are fulfilled, a company can go for buyback. And whenever the company goes for buyback, it affects the earning per share, it affects the book value per share, and it also affects the debt equity ratio of the company. So buyback of shares by a company is a strategic decision, and one need to understand the effect of buyback on EPS, on book value, and the debt equity ratio. Thank you very much.